What's up, people? So today I want to talk to you about what's the best way to pay off multiple credit cards as fast as possible. And this especially applies if you have payday loans, but you probably should have paid them off before even clicking on this video. Payday loans are the worst thing you can ever have, obviously, with interest rate that's several 100% every year. So if possible, pay that off as soon as possible. I would even recommend not making payments on credit cards just to get the payday loan taken care of. But that's not really what we're talking about today. So today we're talking about two of the recommended ways of paying off credit cards, and then my way, which is obviously way better. So the number one is the Dave Ramsey method, the debt snowball. So Dave Ramsey recommends that you cut up all your credit cards, never use another credit card ever again in your life, and then you make the minimum payments on every single credit card that you have, except for the one with the smallest amount. And then you pay off the smallest amount that you have while making the minimum payment on all your other credit cards until the smallest one is paid off. And then you have much more that you can spend on the next smallest amount. So that way, the amount of that you're paying off keeps increasing while the total balance keeps decreasing. And obviously, it adds up to a significant amount. Let's say you have 5 credit cards with $25 minimum payments. Then after the third one, there's an extra $75 every month that you can spend on the next higher card. So that's why it's called the debt snowball. It kind of tends to snowball into bigger and bigger payments on the higher and higher amounts that you are trying to pay off. The next one is the debt avalanche, which is basically the same in that you stop using credit cards, you cut them up, you never use them again, and then you make the minimum payment on all your debt except for the one with the highest interest amount. So let's say you have 2 credit cards, one with 15% interest, one with 25% interest. Even if the 25% interest one has the higher amount, you pay that one off first. So that one will end up saving you a lot of money in interest if you actually have credit cards with higher balances and higher interest rates. In real life, those two tend to be pretty much the same because the smaller the debt, the higher the interest rate tends to be. So in either case, you make the minimum payments on pretty much everything except for one thing that you're trying to pay off completely. And then you can use the minimum payment that you save in increasing the payments on the next debt. So the third way is obviously hitting the like button because that will help out a lot. And then there's my way, which is the debt ice age, or so I can't really top avalanche. So, it's glacier. Anyway, so what I tend to do is you need to fix the spending problem first. And I don't think cutting up the credit cards really do that. So I don't recommend not using a credit card ever. I actually recommend using a credit card for literally everything all the time. You do need to keep track of your spending. You do need to be aware of your spending, and you need to not overspend. But I think that is unrelated from using credit cards and knowing what credit cards really do. So if credit cards just enable you to spend more money than you really have, then I think there's an underlying problem that you need to fix. I don't think there's a problem that can be solved by just cutting up the credit card and never using it again. Obviously, if you keep spending more money than you actually have, then your bank account will just go towards zero and it'll probably stop there. That is dangerous as well, though, because there's overdrafts which cost a lot of money. So what I would do is you try to use one credit card for all your purchases. This one credit card is the one with the highest balance, probably, or the highest interest rate. You try to make the minimum payments on everything else, and you keep using the credit card that you're currently trying to pay off. And then as soon as payday comes around, you obviously know how much you will be spending in bills every month, so, and which day you need to spend those bills. So on payday, you have the whole remaining amount that you don't need to spend on bills until the next payday, and you make a big payment on the credit card that you're trying to pay off. And then you're left with about zero money in your bank account, and you keep using that credit card for all the purchases that you're trying to make. And then the next payday comes around, and you're hopefully having a lower balance at that point than the last payday. And again, you're making payment towards the credit card that you're currently using. This way, you're actually saving a lot on the interest, because the median amount between paydays is what you don't have to spend interest on. This compounds as soon as you get it paid off finally, because generally credit cards work by giving you a grace period of around 4 weeks, some a little shorter, some not very many, a little longer, but around 28-30 days. So if you get the whole balance paid off, you keep using the credit card, you get a bill at the end of the month, and you pay it off like 4 weeks later, and you don't have any interest at all. So you can try to use that same credit card and try to get it paid off every payday while kind of working on the next credit card. And as soon as you have enough buffer on the next credit card to use it exclusively while not using the current one, you work on the next credit card by, on payday, making the biggest payment that you can on that credit card, and then using it to buy everything that you need, groceries, to try to pay the bills and everything until the next payday. So this will save you a lot of interest, and it's mathematically the fastest way that you can pay all of your credit cards.